In the middle of February 2026, the entire southern Ontario real estate market appears frozen in place, completely locked in a strange, unmoving holding pattern. Macro data from the Toronto Regional Real Estate Board shows home sales are down 6.3% year-over-year, totaling just 3,868 transactions. Prices are also sliding. The Greater Toronto Area average selling price fell 7.1% to roughly $1.01 million. The MLS Home Price Index, or HPI, a metric that tracks price changes for a specific benchmark home type rather than a simple average, dropped by 7.9%. Under standard economic conditions, a drop in sales volume paired with an 8% price decline typically signals a transition into a buyer's market. However, buyers active in 2026 are finding that sellers are not capitulating. Despite the declining metrics, buyers lack the total negotiating power usually found in a market downturn. This has created a sideways market. Conditions are technically balanced, but the market feels gridlocked. The explanation for this paradox lies in a specific supply-side data point. To understand why prices have not dropped further, we have to look at new listings, the volume of homes entering the market at any given time. This chart compares sales volume in blue with new listings. While buyer demand contracted by 6.3%, new listings plummeted by a staggering 17.7%, falling to just 10,705 units. Seller supply is collapsing at nearly triple the rate of buyer demand. This is driven by discretionary sellers. Homeowners who are not forced to move are simply refusing to list their properties at current valuations. This withdrawal starves the market of inventory. With fewer homes available, the remaining buyers are forced to compete for a shrinking pool of properties. This artificial scarcity is acting as a floor, preventing prices from falling below that $1.01 million average, despite the lack of sales. This listing deficit is the invisible force keeping the Southern Ontario market balanced in early 2026. Beyond local inventory, every transaction is shaped by the cost of capital. In 2026, the Bank of Canada policy rate has stabilized in the mid-2% range. While these rates are historically moderate, when combined with current federal mortgage stress tests, they place a hard ceiling on how much debt a household can carry. This ceiling has had the most significant impact on the detached housing market across the GTA, Hamilton, and Waterloo. Because detached homes carry the highest price tags, they are the most sensitive to interest rates. As buyers struggle to secure large enough mortgages, this segment has seen the most pronounced price corrections. Sellers in the detached market who must sell due to relocation or financial changes are being forced to accept lower prices to find a qualified buyer. The top tier of the market has hit a mathematical limit, resetting the valuation of the single-family suburban home. While detached homes are correcting, the market has fractured. A different class of property is proving much more resilient. This is the missing middle: townhomes, row houses, and semi-detached properties that represent the only viable option for many families. Buyers who are priced out of detached homes are moving into the missing middle, sustaining high levels of demand. However, these homes are not being built fast enough. Zoning delays and provincial policy gaps have created a structural shortage of medium-density housing. Because of this shortage, prices for townhomes and semis have stabilized. They are performing significantly better than larger, more expensive properties. Southern Ontario no longer has a single, unified housing market. It is split into two speeds, based entirely on price point and property type. In this environment, buyers are using geography as a tool to manage their budgets. In the city of Toronto, inventory remains tight. Inner suburban neighborhoods near transit lines are holding their value because they offer the most convenient access to the core. In Peel Region, buyers are targeting older detached homes in central Brampton to find more attainable entry prices. The trade-off is clear. Buyers choose smaller lots for manageable commutes. Eastward, Durham Region is the primary affordability play. Oshawa and Clarington draw buyers capped by high borrowing costs. Geography is acting as a pressure release valve. Buyers aren't leaving the market. They are simply moving further out until the monthly payments align with their income. Beyond the GTA, we look at months of supply. This metric tells us how long it would take to sell every current listing if no new homes were added to the market. In the Hamilton-Burlington area, inventory previously surged to 4.5 months of supply, which put downward pressure on local prices. By February 2026, Hamilton has absorbed that excess. Inventory is now trending back toward its long-term balanced average. Further west, the tech hubs of Waterloo region, which sits between 2.3 and 2.5 months. This is an increase from the record lows of previous years, but it is not high enough to indicate a market crash or oversupply. Across every subregion, the data confirms that the predicted flood of inventory never happened, solidifying the sideways market. These statistics reflect a shift in how buyers and sellers approach the market. The bidding wars of previous cycles have given way to more deliberate behavior. Buyers are taking more time to make decisions. They are increasingly including conditions for financing and home inspections to protect themselves from overpaying. Investors have also changed their approach. They are prioritizing rental yields and cash flow over the hope of rapid price appreciation. Sellers are now split into two groups. Realists are pricing their homes for the current market to ensure a sale. The withholders are waiting. By keeping their homes off the market, they are unintentionally creating the listing deficit that is supporting current prices. The market is no longer driven by speculative momentum. It is now a market defined by fundamental data and hyperlocal analysis. As we enter the spring market of 2026, many are wondering if this sideways trend will finally break. TRAB data suggests a slow, grinding recovery, rather than a rapid price spike or a collapse. With interest rates remaining stable and listings staying low, the sideways recovery is likely to continue through the second quarter. Without significant policy changes to increase the supply of medium-density housing, affordability will remain a primary challenge for buyers. In 2026, success depends on ignoring broad headlines and focusing on the specific metrics of individual neighborhoods. The February 2026 market is behaving exactly as the data suggest it should. In this environment, patience and verified research are the most important tools for any buyer or seller.